Okay, the market's up 0.6, 0.7%, 10,213, some 50 points off the lows, but not quite at the high, which was essentially right at the open. You're with us here on a fresh new edition of Midcap Radar. I am Prashant. With me is my colleague Samira. Hi, Samira.
Hi, Prashant. Good afternoon to you as well. And for the market, well, it seems like decent going. We're off the highs and a lot of numbers also coming too. So Radhiko Khaitan over there, we didn't have polls for it, but we did have estimates from MK. And it's pretty much in line, at least a profit number. I think there's some debt reduction as well. We'll just get the details of that. But for now, at least the profit number looking bang in line with what MK was estimating, which was about 49 crores. So at 49.5, this looks good. A 15% growth on the top line also seems pretty much okay. What we do have to watch out for is the premium product growth as well as, the margin improvement that they would have seen. So 39% improvement on EBITDA is again in line. 17.7% margins will look good for the street. So that's on Radhiko Khaitan. But for now, the stock reacting very well to the numbers.
Oh, absolutely. Just a quick word on the other indices as well before we move any further. Let's quickly put up the Bank Nifty, the mid-cap and the small-cap indices, and then we'll sort of take it from there. Bank Nifty is up 0.6. I mean, actually almost identical in terms of price movement today to the Nifty, and the mid-cap and small-cap indices next on your screen. 0.8% or so, quite a bit from the lows, but not quite at the high point. But this is a decent showing after what looked like an extremely poor performance which bulls put up. Sharp open, gap up opening, and then going back to being up just about 10-15 points on the Nifty. From that point, 50-point bounce is good. Here are the headlines as we begin the next 30 minutes. Market opens higher as oil prices ease but trended lower through the course of the day. We have some bounce now. The mid-cap index is outperforming. HDFC Twins and the Bajaj Finance stock are leading the gains.
Arvind Sanger of Geosphere Capital Management says India has never outperformed when crude falls due to global growth concerns. Adds that the big global fear now remains the impact of the China slowdown.
Kotak Mahindra Bank reports an inline set of earnings in the second quarter. The stock sulks in trade as the net interest margin comes in at the lowest level in the last 13 quarters.
Bharti Airtel confirms a CNBC TV 18 news break, announces an investment of $1.25 billion by 6 global players in their Africa business, intends an IPO on an international exchange.
Another CNBC TV 18 news break confirms Zydus Wellness, jointly with Cadila Healthcare, proposes to acquire the Kraft Heinz's India portfolio for 4,595 crore rupees. In an exclusive conversation, Cadila Health's Sharvil Patel tells CNBC TV 18 that the combined entity will have revenues of 1,700 crores. Okay, so that's the last FMCG M&A which has come through. We will get back to that with more details in a bit, but as always, Ashwini is with us on the top of the half hour. Ashwini, thanks very much. So the bounce is materialized. More to go. Will we see the highs of the day? Reclaim the highs of the day?
See, the important issue here is that 10,150 has been protected. So the bears which tried to take the market lower failed at a higher level. The other thing is that IT was going down for last few days when Bank Nifty was outperforming on the upside. That has turned around. So now the market seems to be having more support. Plus, NBFCs are continuing with their rally. Most of them are now up 7 to 10%. So my sense is that the last couple of hours you should have finally the short covering on Bank Nifty that everybody is expecting. And I wouldn't be surprised if you get back to the high point of the day, because I think bears have tried their luck all day. And now it appears to be clear that we are going to possibly sustain 10,200. So even now this is a good time to get long on Bank Nifty, etc. because this rally is just about beginning. It's finding support, it's moving higher. So things are just kind of starting out. Having said that, on individual stocks, Bajaj Finance is now showing follow through. So this is a buy with a stop of 2200, target of 2320. Berger Paint is a buy with a stop of 273, target of 287. And Repco Home is a buy with a stop of 354, target of 368.
All right, Ashwini, thanks very much for joining in. Jubilant Food same-store sales coming in, growth coming in at 20.5%. Mangalam, looking good?
Looking good, absolutely in line with what the street was estimating. Sumera, 18 to 20% was where the poll was. The company has gone ahead and outperformed a little bit, 20.5%. And they've opened 24 stores of Domino's Pizza, closed one. That is important because the street was working with 15 to 20 stores opening. The company had earlier alluded that, the pace of opening new stores will increase, and that has happened. So they've opened 24 new stores, closed one. And in doing so, they haven't, incurred more expense because rent as a percentage of sales has come down year on year as well as quarter on quarter. So rent as a percentage of sales stands at around 9.4%. This compares with 10% that it was in the comparable quarter. And in the previous quarter, which is Q1 FY19, it was at around close to 9.6, 9.7%. So yes, the company is opening new stores, and also that could have the rent as a percentage of sales coming down could have been a function of the new information that we're getting. They've closed 5 Dunkin' Donuts stores and they haven't opened any more. So reducing losses in Dunkin' Donuts, improving performance of Domino's Pizza is something that is aiding the earnings. Total store count for Dunkin' Donuts stands at 32, so they more than halved their Dunkin' Donuts outlets over the last 1 year, and they have guided for break-even by the end of this year. 20.5%, absolutely in line. The bigger question, however, is what happens from the third quarter onwards, because 20.5% has come on a base of 5.5%. From the third quarter onwards, you have 17.8% in terms of your base, 26.5% and 25.9%. And this quarter was also aided by Navratri shifting to the third quarter, because Navratri is a low period for pizza ordering. So next quarter, or rather the current quarter which is underway, there will be Navratri, and the street is valuing the stock at 42 times FY20 earnings after factoring in 100% EPS growth from FY18 to FY20. So yes, a lot is baked in the pizza, but the company goes ahead and outperforms. The stock is at the high point of the day because it's off the record high also.
All right, Mangalam, thanks very much for that. That's Jubilant Food. Bajaj Fin is the other one, now seeing an over 8% rally as we speak. It's spiked up now to the high point. And in fact, if you look at the contribution chart, you'll see that, along with the HDFC twins, Bajaj Fin is actually one of the top contributors today to the Nifty. It has a very, very small weightage on the Nifty, but it's all on account of this big move that we're seeing, that it's actually giving about 10 points to the gain that we're seeing now. But let's focus on some numbers which have come through. Karur Vysya Bank, that's seeing some gains. They've posted a mixed bag in Q2. A decline in loan growth coupled with asset quality deterioration has kept margins under pressure. PR Sheshadri, the MD and CEO of the bank, now joins in. Mr. Sheshadri, good afternoon. Thanks very much for joining in. So we'll get to the internals of the quarter in a bit. Would just like some more details. One, could you give us what the NIMs were this time around, and also the slippages?
Thank you very much for having me on the show. The NIMs haven't really moved that much. We were at about 365 basis points, and we've moved down to 357 during this quarter. But that's on account of higher available for sale securities that we were holding. It's a complex issue that caused it to drop just a touch. But we don't see that as a problem going forward, actually.
Okay, and what about your slippages?
Our slippages were actually came in much lower than the last 4 quarters that I've been around in. We came in at 144 crores of total slippage, which is gross incremental NPA accretion at about 1.2% of the total book. The provisions that we created were in the order of 206 crores as against a gross total slippage of 144 crores. That is to ensure that the net NPA number continues to improve. So quarter on quarter, we have come down. Our net NPA number is now down from 4.5% to about 4.4%. And we intend to continue to overprovide as we go forward and ensure that the net NPA numbers continue to close. Over the quarter, we've improved the risk in the book quite considerably. Every risk metric that we have as a bank has improved very dramatically, and therefore we believe that this was a quarter for consolidation, and as we go forward we are reasonably confident that better numbers should come by.
Mr. Sheshadri, so could you said it's much lower, the slippage number is much lower than the last 4 quarters. On an average, what were slippages tracking at, and You said for this quarter it's about under 150 odd crores or so. How is this number? I mean, what is the asset quality picture looking like? What visibility do you have?
In our investor deck, which should be uploaded anytime now, we've been disclosing what the SMA2 numbers are on the corporate book. The SMA2 number quarter on quarter has now improved from 1.7% of the corporate book down to about 1.3% of the corporate book, which is SMA2. Every other metric that we normally track from a risk perspective is better. The duration on our available for sale securities, which causes a big change in the depreciation that we need to take on account of interest rate increase, has also dropped quite considerably. So we've consciously eliminated risk from the book, which is what makes us feel reasonably comfortable at this point in time.
All right, Mr. Seshadri, request you to just stay on for a bit. There's some news flow coming through. Actually, our correspondent Sapna is picking up news from some government officials. Remember, there's been this whole talk about lending from PCA banks, actually, and so far there was a meeting of the Reserve Bank as well. We don't know what has come through from that meet, but now government officials are telling Sapna that there's some sort of compromise that should be made on PCA norms, that there shouldn't be any rigid regulatory policies. In fact, Sapna Das is joining us now as well. Hi, Sapna. What more are you picking up?
No, so this is basically a broad sense, at North Block. The fact remains that this pitch is very clear. In the sense that, some kind of relaxation, some midway compromise, if possible, should be worked out, because, in the government quarters, there is a bit of a worry in terms of the bank lending. Though, of course, the Reserve Bank will have its own view and their own data. So this is a pitch that continues. We need to figure out, basically, the RBI board has just happened yesterday, and this was one of the agenda items we are given to understand. So we need to understand now that what is the look forward, because, the regulator obviously has its own concerns, and rightly so. So has a breakthrough been worked out, or this is going to be a time-consuming issue in the sense that still needs to be worked out. The dialogue will still continue most likely. But this pitch is very clear, and, it's across the policy corridor here in Delhi. So needs to be noted, and we'll see. We'll keep a watch on this and see how it really pans out.
So that's the government's position that you're putting up, I mean, in terms of where they're coming from.
Absolutely.
All right.
Absolutely, Prashant.
Got it. Sapna, thanks very much. Appreciate you getting us those details. And of course, we'll keep you on top of that story in terms of what comes of the meeting. Okay, Mr. Seshadri, thanks for waiting, sir. So could you tell us what was the net interest margin in the quarter?
The net interest margin was 365 basis points was the net interest margin.
Okay.
357, yeah.
3.65, right?
Prior quarter. Yeah. 3.57 for the quarter, 3.65 for the prior quarter. So it's down 8 basis points.
And again, here, I mean, what levers do you have? What will this track at, this number?
Difficult to sort of predict, but in the investor deck that we are in the process of uploading, we've said that we've put in place risk-based pricing on our retail products. So we've gone digital. The new retail products are fully algorithmically scored and underwritten, and they are risk-based priced. And on the risk-based pricing in the first quarter to the second quarter, our pricing has risen about 13% from the price that we got on Q1. We've also put in place risk-based pricing on the commercial business lines. That's going live now as we speak. So we'll get the full impact of that this quarter. So in our view, our NIMs will expand as we go forward. We are at this point in time suffering from what bankers would call basis risk. Our liabilities are repricing differently from our assets, and that is compressing it temporarily. We don't see this as a permanent compression. In fact, our own expectation is that from this quarter onwards, our NIMs will look different from what they've hitherto looked.
Fair enough. Got it. I mean, just one last point. What is your exposure to NBFCs, commercial paper, that kind of thing? I mean, if you could just tell us if any, and are you active in that space?
We're not particularly active lenders to NBFCs. We do have a small exposure to NBFCs. It's roughly about 4% of our total book is the direct lending to NBFCs. Our exposure to non-governmental financial services institutions on the investment side is very, very small. I don't have the real number with me at this point, so I don't want to hazard a guess, but it's quite small. So, we think that our risk on that front is reasonably contained. And much of the business discussions that we are having with NBFCs is with respect to doing either co-origination of loans or in terms of buying out their portfolios. So there is very limited exposure by way of direct lending to them.
Are you looking at buying any of the loans?
Yes, we are in discussion.
Could you give us a sense of what's the quantum that you might consider?
Ma'am, these are all early stages of discussion. These are subject to us agreeing on how the transactions are to be structured. We'd like to ensure that we make them bankruptcy remote if that is technically feasible. So it's very difficult for me to give you a number at this stage.
But would be retail housing, is it, or consumer loans? What kind of loans?
We are open to both retail housing and consumer loans.
Okay, fair enough. And that 4% that you mentioned, that is what sort of loans in what segment that you lend to NBFCs?
This is broad segments, largely related to the consumer side of things. Very limited exposure to housing finance NBFCs, but more to other direct consumer lending and NBFCs.
Okay, Mr. Seshadri, thank you for your time. Appreciate you joining in, and good speaking with you, sir. Thank you. We take a very quick break. The first on the show. We come back. We keep it with the market. 55 still on the Nifty. More coming up on the other side.
Hi, welcome back. We should be getting the Bajaj Auto earnings anytime now. The expectation is that the quarter could be a tad big on the weakish side. Okay, 1152.5. So it's just a tad actually below our own expectations, which was expecting about 115. Sorry, it's in line absolutely. 7987. Is also pretty much in line. Our own poll was just a shade above 8,000 odd crores, so that looks good. So far it's bang in line. It was expected to be a tad bit weakish. There's expected to be margin pressure as well this time around. So 1343, again an inline number on the EBITDA. Demand is what we'll have to see. 16.8% on the margins. This is not going to go down well, I think, because I think even the worst estimates weren't expecting it to actually fall way below 17%, but at 16.8 it should be, I think, their lowest. I have the numbers here from Q1 of FY18. And in the last 5 quarters, at least, we've seen margins sustaining above 17%. So 16.8% is going to be a tad bit, for miss. Sonia, what's your first take?
Oh, absolutely. It's a big EBITDA miss that you're seeing, for Bajaj Auto this time around. Now, the EBITDA growth, if you look at it, has come in at a multi-quarter low. It's just a 3.5% year-on-year growth that we've seen in the EBITDA performance compared to a 36% growth last quarter, a 45% growth the quarter before, and a 20% growth in Q3. So the growth rates have slowed down substantially, and this 16.8% number compares to 17.3 last quarter and 19.4 in the quarter before. Now, the reasons, as we've been stating, one is, of course, the raw material costs have gone up, but Bajaj Auto has taken aggressive price cuts in some of their key products like the CT100. So blended margins have been under pressure. Also, although the export numbers have gone up, this time around they've realized exports just at 69.5 because they've hedged exports. So the benefits of the rupee depreciation has not flown through this time. So they couldn't couldn't really make the most of that. Missing estimates on the margin front. What we now need to calculate is what the realizations have been for them per unit, because on that as well, we are expecting realizations to fall to almost 59,000 rupees, which is about a 3% fall in realizations. Given these margins, I reckon that the realizations could also be under pressure for Bajaj Auto, but this definitely is something that will not go down well with the street at all.
Okay, we have some experts joining in. Nitesh Sharma, Prakash Diwan and Bharat Gyanani join in. Gentlemen, good afternoon to all of you. Prakash, let me come to you first. You know, numbers are in line. I mean, it was expected to be weak, but EBITDA margins coming in at 16.8% is going to go down as a miss, right?
No, absolutely, Sumera. So, you know, we were kind of penciling in the fact that market share at any cost was the kind of decision that the management had taken and articulated. Now, if that was the case, they haven't been able to increase much of the prices, and they've started taking a hit in terms of the RM cost going up. So this was bound to happen. But what's worrisome is that the trend is that, you know, margins are shrinking even before this was the case. And now if that has to continue, at some stage this will start worrying the street because, you know, you can't be having such...
All right, we'll come back to you. Prakash, we can't hear you very well. I just wanted to also talk about the realizations. So the realizations this quarter are down 1.5% on a quarter-on-quarter basis at 59,641 rupees per unit. This is lower than the street expectations as well. Remember, last quarter they did 60,500 rupees a unit. So realizations have fallen quite a bit too. You know, I think the problem for Bajaj Auto began last quarter when it junked its profit first strategy. I mean, for 8 years, it had a strategy of keeping profits and margins as its top priority. It junked that last quarter and decided to focus on market share by sacrificing margins. That's why you've seen this big drop come in, and that's what the street has factored in as well. I mean, the stock is now almost down about 30%. Prakash, if we can hear you now, you know, given that the realizations are under pressure, margins too at a multi-quarter low, we haven't seen these kind of margins in at least the last 10 quarters or so. Do you expect a further derating on the stock? I mean, it's already fallen about 25% this year.
No, the reason why there might not be further damage beyond, you know, what seems to be a disappointment today, Sonia, is that this current quarter that we are into has, you know, the dollar value exports would be much better. So last quarter, they've probably, you know, not gained anything because of the hedging at sub-70 levels. But if they were to be now 72, 72 and a half, that would be an added advantage because exports have been very robust. And secondly, the three-wheeler sales have compensated for some profitable business growth. What the bikes business has taken away, probably somewhere that has been offset. So I don't think there's a derating that's in the offing, but yes, the stock will probably have a lid on itself in terms of any further upsides.
All right, Nitesh Sharma, Bharat Gyanani and Mitul Shah are also with us. Nitesh, your first take on the numbers?
Yeah, hi Sonia. So overall, weak quarter for Bajaj. We were expecting the quarter to be tepid, but it turns out to be even worse than what we thought earlier. So Street was looking at a flattish margin performance, but given that the contribution of economy segment, CT100 and Platina increased sequentially, we think that the higher discounting and price aggression both in the domestic market and the exports markets would have impacted the overall margins. So we maintain our caution on the two-wheeler space overall because we think there are multiple headwinds, right from insurance for 5 years, hardening of raw material, ABS and CBS becoming compulsory from next year, adding to the cost pressure, and then from FY21 onwards you have BS6, which adds as much as 15% cost pressure to the two-wheeler OEMs. So taking all these things into perspective, we have a neutral rating on Bajaj and we have a cautious outlook on the entire two-wheeler space.
Okay, neutral rating and a cautious outlook. By the way, in the press release, the management has said that their market share in the domestic motorcycle market has gone up. In September of 2018, they've clocked in a market share of 20.1%. Remember, it had fallen to as low as 16% in Q1 of FY19, but they say that the market share has now recovered to 20.1%, perhaps because of the aggressive pricing that they've done, especially in their, you know, in products like CT100. But Nitesh, do you think the exports could cushion their profitability going ahead? Because, you know, this quarter they've realized exports at I think about 69.5 or so. They did mention to us earlier that they will be realizing exports at about 72, 73 April onwards. So that would mean higher profitability for them. Going forward, do you think the export profitability will sort of cushion the fall in the domestic market?
So earlier there was some expectation that export margins could cushion the price aggression of the domestic market that the company is alluding to. But what we understand through our industry checks is even on the export front, the company has become aggressive and is passing most of the benefits it is accruing on the currency to the end market. So price competition is also happening on the export business as well.
Okay, all right. Nitesh, thanks a lot for joining us. We have two more guests joining in, Bharat Gianani and Mitul Shah with us. For those of you who've joined in late, Bajaj Auto has reported a disappointing set of numbers. The margins have fallen almost 300 basis points on a year-on-year basis. It's come in at a multi-quarter low of 16.8%, hit largely, one, because of higher commodity costs, also because of the aggression that they have had in the commuter segment. So the aggressive pricing, the undercutting that they've done in products like the CT100. Their realizations have fallen 1.5% on a quarter-on-quarter basis and 3% year-on-year. Bharat, your thoughts on the stock? Would you downgrade the stock at all post the numbers, or do you reckon that exports could sort of cushion Bajaj's profitability going ahead?
Yeah, good afternoon to the viewers. We had actually downgraded the stock a quarter before when the management had changed its strategy and pointed out that the market share gains in the domestic segment assume priority over profitability. So that is strategy is now reflecting in started to reflect in financials as well. So we would maintain a cautious view on the stock. We had downgraded the stock from buy to hold, and we will continue to maintain the hold stance.
Okay, so you had downgraded the stock already and you will maintain that cautious stance. Mitul Shah is also with us. Mitul, for FY20, the EPS estimates consensus stands at around 193 to 195. Do you think that these EPS estimates would get scaled down further on the back of this disappointment in the operational performance?
We expect marginal downward revision in the EPS estimate. We already had lower estimate at 181 rupees for FY20. We believe that most of the negatives are factored in at this price, as management already highlighted on various occasions that because of the pricing strategy and the gaining market share, there would be marginal drop in the EBITDA margins, and which has happened. So it is marginally lower than the expectation. We don't believe that it's a very big disappointment. This is what the management has already indicated in the previous con call.
Okay. And on the margin front, you think the worst of the pricing pressure is behind us, both as far as raw material costs are concerned, as well as the aggression with respect to pricing of the CT100, etc.? Or do you reckon that in the second half of the year, they could slip below the 16.8% mark?
We believe that this would be the bottom margins. Company's margin should improve from the current level because, as you pointed out, currency realization in the quarter would be somewhere around 69.5.
Sure.
Going forward, company always follow a range forward contract, which should be somewhere between 72 to 75 or even higher than that. So those benefits will start coming from the second half or in FY20. And on those basis, margin has to improve. On the other hand, crude going up. So its export territories, particularly South African markets, started doing well, and with this economic situation improvement in those countries, export would further pick up from the current level.
Okay.
So overall contribution of export increases that transforms into higher margins.
Okay, thanks a lot, Mitul and Prakash, the other guests as well, Bharat and Nitesh, for joining us. We have the management, in fact. Rakesh Sharma, the Chief Commercial Officer of Bajaj Auto, is with us. Mr. Sharma, thanks for joining us. Same question to you. The margin pressures are showing up this time around. It's almost a 300 basis points fall on a year-on-year basis. What would the outlook be for the second half of the year with respect to margins?
See, foremost, I would like to make the point that the margins which you are seeing, it's a blended margin, right? And we've got three different businesses. There is the domestic motorcycles, there is the commercial vehicles domestic, and there is the international business. So the outcome is the outcome of the performance of each of these businesses. Now, what has also happened is that the international business has done pretty well in this period. And within the international business, as you know, it's done well on the back of Africa and these markets coming back. And we tend to sell lower mix of products in Africa. So when the international business weight goes up in the, driven by particularly Africa, when that weight goes up, it has an impact on the margin. And that's what, that sort of explains partly the difference which you are seeing from previous quarters. Second point is, I think I just joined in, so I did hear somebody mentioning, talking about the forex rates, and that's an absolutely right point. We follow a strategy of having certainty, preferring certainty to ride, rather than riding out the ups and downs of the forex. And as a result of which, you know, we have a fairly high level of hedging, and which is giving us a realization of 69. But of course, as the spot market sort of maintains at 73, 74, and as our hedging changes character, this realization is going to start to flow in, you know. To give you an idea, each rupee movement adds about 180 crores to the bottom line, or almost with exports at 40%, it adds about 1.5% to 2% EBITDA margins.
So will you be able to...
This is the future,
sure.
and I think...
Sure. Will you be able to cash in on the full benefits of the currency, Mr. Sharma, or will you be forced to take any cuts, price cuts in the export market?
No, we are not being forced to take any cuts at this point of time. Our retail franchise, our competitive positions in key markets is fairly strong, and the extra realization which we have got, marginal at this point of time, but which is expected to increase, particularly as we enter the new financial year. We are under no pressure to pass that on, really, because our competitive position is pretty strong and fairly benchmarked in general. Now, there may be one or two markets here and there we have to make some adjustments, because, you know, if you're a very big leader over there, then you tend to sort of shape the market, and we may play this price demand elasticity curve a little bit in those markets. But generally, we are under no pressure.
So overall, what would the blended margins look like for the company in the second half of the year? When we spoke last quarter, you did indicate that you're looking to sort of pursue market share at the cost of margins. Should we expect more pressure in margins, or will it be around this range itself, or of 16 to 17%?
See, I want to repeat this again. This is not some policy which we have embraced, that we are going to get market share at the cost of margins. The strategy is to be viewed slightly differently. We are decided to focus in domestic market on the entry level and the sports segment, right? And the sports segment obviously has a much higher margin. And the sports segment, in fact, our mainstay, Pulsar 150, is the fastest growing model for us right now, right? It's growing much faster than the CT100s or the Platinas, which are an entry-level thing. So now, how exactly the chips fall depend on the, you know, the outcomes during the season. It depends, you know, on the macroeconomic environment, the consumer behavior, the balance of the export business, and these kind of things, right? So it's not that we have decided to, you know, target a certain margin. We are more strategy focused, and the strategy is focused on a few segments, and depending on the mix, etc., we get a blended margin. The outlook, I would say, if the current environment continues, would be similar, you know. But with having said that, I also want to say that this is a period, the October-November period particularly, where the advertising and sales promotion expenses go up slightly because of, you know, this is tactical stuff which you do during the season. So that would be sort of for this period, and that would exert a little bit pressure on the margin.
Okay, so is it fair to assume that because of higher ad expenses and higher raw material costs that the industry is facing in general, and inability to sort of pass on the raw material costs because of competition, your margins will be subdued even in the second half of the year around these levels itself?
Yeah, they should be around these levels in the same region, but the industry as well as us have been passing on, the part of the raw material costs. Everyone is a little bit tentative when you come into the all-important festival zone, because nobody wants to take a misstep during this time. And therefore, I would say as we enter Q4, the dust has settled and more of an equilibrium level of operation starts to occur, and that's the time to start to correct the margins, etc., for everyone, including us. So I would say yes, on the balance, the plus and minus of it, we would expect to be in a similar region.
Okay, we'll expect to be in a similar region. Thank you so much, Mr. Sharma, for joining us. So that's Bajaj Auto for you. I would say that the commentary is a bit cautious. Expenses will go up in the quarters to come. Raw material cost pressures are higher. Ad expenses will go up, as he said, and margins will be in the similar region. So in the second half of the year, don't have any expectations of any recovery. I think that's why the stock as well is under quite a bit of pressure.
Yeah, not just the stock. Actually, it looks like the entire market, the sentiment has soured. Look at the Nifty, for example. It's now down pretty close to the lows of the day, just barely holding on to the green after having slipped into the red earlier. The Sensex is now down about 35 odd points, and it's been a very sharp slide actually in the last few minutes. The Midcap index from the morning highs has now lost about 200 odd points, and the Nifty Bank, which at one point was actually one of the better performing indices, that index is now about 0.25% in the red. Yes, Bank looks to be a big culprit over there. The stock is down about 4 odd percent. It's now at the lows of the day. Amongst some of the other stocks which are losing ground, actually this whole banking pack, so SBI, the HDFC twins, I mean the HDFC is still holding on in the green, but it has come off. Other than that, we have IT, which has extended its losses, and also of course Bajaj Auto is now one of the top drags on the Nifty. But we'll wrap up on Midcap Radar and take through the market action forward with your stocks. Stay tuned.